Welcome to EDS, and in this video we are going to take a look at how you can write your own options contracts and how you can collect your premium upfront and generate a consistent return year on year. So the first thing you want to do is go into your brokerage platform. I'm using tastytrade, and then you want to see where we are in the options chain. We are going to be using options. We're going to be writing the contracts, not buying them. We're not going to be gambling. We're going to be essentially selling insurance, like an insurance company. So we want to see where we are in the options cycle. So as we can see here, if we just pull up something like GDXJ, we've got the weeklies denoted in the orange W, and then we've got the monthly expirations, which is just everything else. Our first monthly expiration is September 20th. That is a bit too close, 7 days away, so we will go to the next one out, October 18th, which is 35 days away. So now we know we're going to be about 35 days out in time, okay? So what we can do is we can come over to our watch list and then filter out everything that has earnings within the next 35 days. So we can filter out everything that has earnings within the next 35 days. And what we are left with is a list of things that we can trade that does not have earnings over the next 35 days. The reason why we don't want earnings is because it will increase volatility, it can mess up your deltas, and it's not what we want for the bread and butter of our portfolio. Of course, you can make earnings plays, but that's separate. For what we're doing, we don't want to be anywhere near earnings. We also can filter out low liquidity things. So basically we can select 3 and 4 star liquidity underlyings only. Right, 4 stars are highest, so 3 and 4 stars only. So what we've got now is a list of things to trade that we know is very liquid and we know doesn't have earnings for the foreseeable future. Now we can order everything from high to low IV rank. The reason why we do this is because we want to sell volatility. Volatility contracts most of the time in the market, so we want to be selling when volatility is high and then playing the contraction. And what we want to do at this point is we want to kind of make sure we're above 50. In this current market condition, above 30 is okay, but generally speaking, we want to be above 50. So this would be the kind of mark here, you know, from CL, which is crude oil futures, and up. However, you could go a little bit lower to say AVGO at 46.1, Starbucks, XLE, you'd be completely fine. So at this point, what we want to do is want to see what our current portfolio looks like. Okay, we want to see what our current portfolio looks like, and then we can base our new positions on the back of that. So, for example, in this portfolio, we've already got an SMH position, an AMD position, and an Intel position. So we wouldn't be going to look for positions on Nvidia, for example. We have a position on UAL, so we wouldn't be looking at a position on BA. For example, things like that, right? So you want to make sure that everything is nice and nicely diversified. You can look at your beta weighted deltas if you want, but let's just say you've got a blank portfolio, you've got no positions on, so you've got full freedom to place any trade that you want, right? So let's just go down the list. So we've got Euro futures at the top. We've got FXE. We've got US Steel. We've got Kronos, Intel, GDX, GLD. We've got the British Pound futures, General Motors, BA, Silver futures, QCOM, EWW. And basically, we're just going down the list, and we're trying to collect as much information as we can. We're trying to look at the liquidity level, the IV rank. We want to see what it's trading for. For example, if you want to sell a one lot strangle in EWW, that's trading at $54, it's going to require a lot less in buying power than if you wanted to sell a one lot strangle in GLD. Which is trading at $238. So you want to be keeping an eye on a lot of different things. I think, do you know what? Just because we did make a point earlier on that we can trade things like Starbucks and AVGO, I think we can just look at a position on Starbucks. Why not? So Starbucks is currently trading at about $100 a share. It's got an IB rank of 44.9. So if we were to go into the options chain, as we can see, it has earnings on November 7th, which is far away from October 18th, which is fine. So we just pull up October 18th, and as we can see here, this is now the options chain for October 18th. This orange bar here is the expected move of the underlying. So what this is telling you is the market is predicting that over the next 35 days, the price will stay within this range here, this orange bar. So we want to be selling contracts further out than that range. So what we want to do is, personally, I like to go with anywhere from a 16 to 20 delta. So if you look on the put side, there is no 16 to 20 delta on this side. However, there is a 13 delta at the 90 strike. And if we go over to the call side, there is the 25 delta. So a little bit light on the put side, a little bit heavy on the call side. However, both of those combined, as you can see, this green bar is our break-even point. This break-even point, the green bar, covers the orange bar, meaning our break-even points would be wider than what the expected move is predicted to be, which would lead to a high probability trade. As we can see here, we've got a 68% chance of profit. We have an 85% chance of hitting 50% of max profit at some point in the next 35 days. Would get $6 in daily theta decay, would collect $174 upfront in premium, and it would require $1,400 in buying power to be tied up. So all in all, this is a position on Starbucks. This actually looks like a very nice position. It's actually a decent, healthy amount of premium. We've got a nice IB rank. Let's say if this was too much buying power for your liking and you wanted to reduce that, what you can do is simply just buy a contract a little bit further away from where your short is. So the next strike down for the call side would be 110, and the next strike down from the short put would be 85. So as you can see here, we've created a $5 range on that side, $5 range on this side. This has now reduced our buying power requirement right the way down. It will reduce the amount of premium we collect up front, but it massively reduces the amount of buying power required. In exchange for this, we do have less theta decay per day, and we do have a slightly lower probability of profit. However, our return on capital is much higher this way. So if you wanted to place that trade, that wouldn't be a bad trade in my opinion. And that's basically how you go about finding new positions. So let's say, for example, Starbucks wasn't ideal for you, right? By all means, go with AVGO, go with Uber. These are, go with XLE. XLE is the energy sector. It's a whole sector in itself. It's one of the spiders. XLE is great. Let's see if we can find a position XLE. You guys are going to get two positions today for the price of one. So we got a 19 delta on this side. We've got a 19 delta on that side. This position is looking clean already. We've got a 70% chance of profit. 1.2 $1.20 in premium, 1.2k in buying power. We've got 85% chance of hitting 50% profit over the next 35 days. XLE, this is actually looking like a beautiful trade in XLE. But there you go. This just goes to show how easy it is to find these trades. Managing them is a different story. So as we can see here, UAL, we are in the money on this. Currently, markets just opened up not too long ago. UAL, apparently we are in the money. The chart's just not updating for some reason. But as we can see here, we are in the money on UAL. GDXJ, again, we are a little bit in the money on GDXJ. For some reason, the chart isn't refreshing, but that's fine. UAL and GDXJ, these are strangles, so we're not really too worried about it. We can always just roll and fight the position. So we're just going to wait and see what the market does. AMD, SMH, these are both iron condors. Thankfully, these aren't in the money. We just need theta to decay a little bit more on these contracts, and we should be able to get out of them. mRNA is a bit of a yeah, the chart's not updating, but mRNA has had a little bit of a dip, spiked up a little bit. We just need to see things stabilize again. Theta decay. Intel, we're almost at a respectable profit target. We probably will be looking to take Intel off some point soon. And as you can see, if you have been following along in our positions, we have had quite a lot of positions on at the beginning, and slowly by slowly we've just been taking them off like a conveyor belt. We just work the position. When it gives us an opportunity to take profit, we take profit, and then that's it. And then we can add more positions, and it's just a continuous conveyor belt. Just keep working positions, keep taking profits. So with that being said, the only other thing you need to know is how to size your positions correctly. So we have got a position sizing template for you to use. You can get this completely free of charge. All you need to do is enter in your portfolio size. Let's say if it's $15,000, and then you enter in the current VIX level. Let's say if it's 14.3. What will then happen is everything below will be automatically calculated for you. All you need to then do is use this information to form the backbone of your portfolio. It will tell you how much money to allocate to undefined risk positions, defined risk positions, how much to allocate to short premium positions in general. And of course, there is an explanation as well of explaining everything, how it works. So use the position sizing template. You'll be completely fine. There's a link in the description below. Click that and it will take you to the position sizing template. If you do want to follow along on these positions and make money with us, by all means, there is a link in the description to EDS Premium. EDS Premium, what is it? It gives you exclusive access to all of our portfolios, large and small, so you can copy our positions regardless of what size portfolio you have. We have got a full course in there, so no prior knowledge is required. We'll teach you everything you need to know so you can learn and earn at the same time. It is a private community, so you can speak with myself and other like-minded individuals. There's a 100% money back guarantee. So once you've gone through all of the material inside, followed our trades for 6 months, if you haven't been profitable, then we will work with you for free until you are, or you can request a full refund. So it's completely risk-free on your part. It is £1 a month right now. It's super cheap. The price will be increasing. However, whatever price you get in at is the price you're locked in at. So you never need to worry about price increases. Once you're already in, you are rewarded for getting in early. With that being said, I'll see you guys on the inside.